You screwed up and put it in the wrong thing. It's a horrible investment. You chose to buy more of this crap. Don't put it in this crap. I think you ought to keep it. It's perfect for you. Thanks for the call.
Oh, yeah, let's run this bad boy right freaking now.
Hey, Dave. Glad to talk to you.
You too, man.
Enjoy your show.
Thank you.
All right. I am calling in response to a video I saw recently that you claimed infinite banking concept was a scam and actually got quite pissed off about it.
Oh.
So I do not agree with that and certain points that you made in that video. And I have set up a policy.
You think he's
for my
going to bring
son,
numbers?
when he was 1 year old. He's 5 now.
I'm sorry.
Say I'm sorry.
Say that again.
I said I'm sorry.
Yeah, so am I sometimes. No.
I feel you.
So I set that policy up for him when he was 1 year old. It has a $500,000 face value. We pay $5,373 a year for 13 years, and
Jeez,
I
it's
can't
paid
wait to do
up
math
at
on
that
this.
point. There's a few points that I wanted to discuss that I just didn't agree with.
Okay.
Do you want to just kind of take one thing at a time?
Sure, that's fine. Sure.
Okay. One of the main things was that you claim that the cash value dies with you, and you only get the face value paid out.
That's true.
That is, well, it's not true if you reinvest the dividends back into the policy.
Dividend reinvestment is not cash value. Dividend reinvestment is because you have a mutual company and the policyholders are the owners of the company.
Well,
and so the profits from...
Let's talk about that. I want to talk about that. So dividends come from all whole life policies. You don't have to be a mutual company. The biggest difference between a mutual company and a stock company is going to be how the dividends are divided up, right?
yeah, I mean, it goes to the shareholders or the policy
Right.
holders.
So you got a pie, draw a line in the pie, certain amount goes to the stockholders, certain amount goes to the policy holders. Well, I guess equity policy holders. And
Let's see I think I know where he's going here, but
I think so too. Let's but I want to make that distinction because everybody gets that wrong.
come to the policyholder and they use that to buy paid up additions. That is not the same as keeping your cash value. That's buying extra insurance with your overpayment.
But
True.
it
That is
still works out to be
No,
much greater than the $69,849 you put into
but
it.
the actual
Right.
cash value, not the paid up additions, the actual cash value dies with you.
No, because
Yes,
you
it
can
does.
think. Okay, but your death benefit is larger than your cash value. So for me, I looked at it
Because you bought more.
Why does no one understand the fact that you're paying yourself when you get, let's go say you got to 100 years old and you paid premiums the whole way through and you've had some gains that's going to come from investing the premiums, so to speak, right? Why doesn't anyone understand that they're basically paying you back with your money?
Because they don't teach people that.
It's amazing to me.
It's a dividend. It's actually a return of premium. That's why it's
return
tax free.
Right.
But I think what the guy on the call, Jim, is missing, the miscommunication here is that Jim is saying, but no, the cash is buying more insurance. But Dave is saying, yeah, but you're not getting that cash when you die because it's buying more insurance. There's a miscommunication here.
I think the bigger issue when people buy policies, they don't understand the distinction between the actual dividend and that balance, right? So they don't understand the difference. There's three different values that people get so confused about this. There's
why?
Right.
They make it confusing on purpose.
They make it confusing on purpose. That's what it feels like, at least. But you're going to have the
whole life is never bought. It's only sold.
It's only sold. I only got one
That's
left.
what we were taught, by the way.
So we came from the insurance world. We've seen all this like a million times. And we've seen the conversations that take place behind the scenes on how they sell it. And as soon as you start hitting people with numbers, they start to have like a meltdown, just a total meltdown.
Which I hope they get into.
I really can't wait. This is going to be so exciting. But let's get to this one point. Three things important that we need to make the distinction. There's paid up additions. That's additional insurance death benefit that you get every time you get a dividend from the policy, just like a stock. If you own a stock, you get a dividend, right? If it's a dividend paying stock, Well, whole life's like a dividend paying stock. You get a dividend, that dividend gets more insurance. If it stays inside the policy and doesn't get used, it gets more insurance. When you're younger, it might buy $3 of insurance for every $1 you leave in the policy. As you get older, it gets less and less and less and less, to eventually to the point where you're putting $1 in from your dividends, you're leaving in the policy, and you're only getting $1 more of death benefit. So distinction. You might have $67,000 in paid up additional insurance, but maybe you only have a balance of $20,000 in dividends that you've received. That's possible. And then there's the cash value, right? Good?
Makes sense to me.
Okay, let's do it.
You know what a paid up addition is? A paid up addition is buying additional insurance.
There you go.
I
That's why
understand
you're
that.
getting more at death. Not because
Right.
you got your cash value, but because you used your policy dividends to buy additional insurance.
Right, but
That's different than getting your cash value. If you took those policy dividends and went and bought a term insurance policy for $100,000, well, you'd get $100,000, but that's not your cash value.
Well, I have a term policy.
I know, but you missed my point. Okay, you're talking about you use the policy
Random comment.
dividends, you use the money they send to you because you're in a mutual company to buy additional insurance.
Yes, paid up additions, yeah.
Yeah, if you buy a term policy on the side for $100,000 instead with that same money, you would get $100,000 more than your face value, but that's not your cash value. That's additional insurance. They're different.
Right, they are different. In term, you don't have cash value to borrow against.
I'm aware of that, but your point was that you don't lose the cash value, and my point is 100% of the time, by definition, you lose the cash value.
So this guy, I think, probably doesn't realize if he removes those dividends out of the
He has no
policy,
idea.
he loses all. So the 60,000, let's just say, he would have in paid up additions. So I'm making this number up, but let's say it's 60,000 in paid up additions, and he took the 20,000 that's actually in built-in dividends that are in there. He loses the $60,000. I don't think he understands the fact that that's not real money.
He thinks that Ramsey's wrong. So I mean, he has to have some knowledge of infinite banking, because I don't know what infinite banking is. So I'm interested to.
Yeah, let's go. Let's just see how this goes.
Okay, so as I said, tit for tat, if he lives to be 80, looking at the readout
I feel
here.
the same way, Dave.
If say he only lives to be 80, okay?
All right.
The cash value will be worth about $2 million, but the payout for the death benefit will be $2.6 million. So, technically, yes.
So you take the cash, you're taking your policy dividends and go buy term insurance with it, and you would have more than you're talking about because you get a better buy on the insurance than you're getting with this rip-off whole life crap.
Yes, you would get a high, but you wouldn't be able to use it throughout your life as your own bank. And I think that's
okay. But here's the thing:
the big thing
that's a side issue. That's a side issue. But your first issue was, he's going to have all this money at retirement. Well, let's just do a little present value calculation on what you put in for a baby. $5,000 a year for 13 years. Do you know what that would be in a mutual fund? At age 88? It would be $25 million, dude.
Oh, yeah, let's run this bad boy right freaking now. Would you like to do the honor, sir? Let's do it.
I get my hands dirty.
I love this.
How old is the kid? 1?
Did we say like 83 years? Then he say 80? What is
88 years, he said. 88 years.
Let's go. Dave likes 12%. Let's not use 12. Let's use something. Let's use 8.9 because that's the actual lowest.
I'm just gonna use 9.
All right, let's use 9.
What do you say? 5,500.
5,500 a year. I think that's what he said. Was it 5,000? Whatever. Let's just do the math.
But it was only for 13 years.
No. He was going for. He said he bought it when the kid was 1.
It'd be only paid for 13 years.
You know what? Hit calculate and let's just play with it from here. I can't wait. It's $130 million.
That's something. What?
But that's wait a second. But that's $5,500 a year for the rest of that kid's life.
That's what I'm saying. He only pays it for 13. So we have to run it for 13 years and stop paying. Which I don't know if we could do.
No, you know what you can do? So just do 13 years.
And then just take that number.
Yeah, and then use that as present value. So $137,000. Now take $137,000 present value and run that for 75 years. And now take out the per payment. This is going to be obscene. $88 million.
Whoa.
So this is the thing. I love this. Like this, we're talking about $2.6 million policy, right? As opposed to if we were using a Roth IRA to do the exact same thing, we'd have $88 million totally tax-free. And I don't hate life insurance. I own it. I own a couple of policies. I've even bought policies for people because they needed to hit certain. Recently, I bought a policy from a friend who needed to hit a bonus with their life insurance company that they work for. Like, I don't hate the product. I own the product. I just think there's tools that you use for certain things, and this infinite banking already, right off the bat, like numbers prove this to be totally inefficient.
Let's give Jim his fair.
Let's give
chance.
Jim a fair shake here. Let's see.
Instead of putting it into this ripoff thing and making 4% on your money, and when he dies, he loses his cash value. If you had put this in a good mutual fund, you'd have 100x, 10x the amount of money, and that's your infinite freaking bank.
But we're only putting in 70,000, and he's going to be.
That's how present value formula works in finance.
Well, he's saying he's putting in 77,000.
Look, let me just take the same.
I mean, I understand.
Let's intellectually deal with this for a second, okay? Take the same amount of money when you get off the air and put it in a financial calculator at 11%, and pretend it was invested in mutual funds, and see what it is when he's 88 years old.
It'll be more.
Oh,
88 million and 9%, so 11.
And he'll have that too. But this, to me,
does no one realize that you could take loans against a investment account?
No, Jim probably has no idea.
I mean, just use a security backline. If you don't want to put in a Roth IRA because you don't want to deal with the back end of that, which, by the way, is super easy. We made a video on that. Okay, it's super easy and it's illegal. It's not illegal. Sorry, it's legal to do. It's illegal. It's not illegal. I know it sounded like that. Then it was terrible. So the thing is, you could just use a security backline of credit. If you want to put it in a brokerage account, you'll still have tremendously more money, and you have the same exact concept here.
Yeah, I mean, you borrow against it. We do it all the time.
Is a way to.
No, he doesn't have that
to borrow against.
That's called opportunity cost on your money. You put it into something that's going to make him at 88 have $2.5 million, and he should have had $25 million. Because you screwed up and put it in the wrong thing.
Oh, well, we screwed up and put it in real estate too, and he's going to get real estate.
Well, then put the money in real estate, but don't put it in this crap.
How are you have
I have to respectfully disagree.
Well, on what basis? He's getting more money if you put it somewhere else.
But he's able to borrow against this.
If you've got $25 million in mutual funds, you can borrow against it.
But he's going to have to wait until he's retired to get that amount of money.
Okay, so you're going to teach him that the way he becomes wealthy is borrowing against money that his father invested for him. That's how he builds wealth. Said no one rich ever.
Real quick, and this is important. Jim said something. He's going to have to wait till he's retired to have that money on the investment account, which is not true. The account value is the money you have access to. On the whole life insurance, that's the one that takes time to build up.
Oh, yeah.
It's a short pay, it sounds, but 13 years or whatever he said. There's going to be no cash value till like the 10th year that's meaningful to borrow against.
I was just going to say, so you have to wait even point, right? What are you going to borrow? It was year 10. That was mine that I owned.
If the cash value is $100,000 at that point, you can only borrow what the cash value is.
Well, not to mention, let's just talk about something really, really like that no one seems to have this conversation. And I watched this happen to somebody. So a really good friend of mine's dad came to me. He said, hey, I have this whole life. He had bought from an agent a long time ago. The unfortunate situation here was he took a loan on that policy. He took it on, I think, in like year 15 of the policy, he took a loan. 15 years later, that loan grew to something absolutely ridiculous. He had some financial trouble, how to let go of the policy. He ended up getting a tax bill.
Yeah.
So he got a tax bill. So think about that. Because he couldn't pay the interest. He had some issues financially. He couldn't pay the interest, okay? That interest continued to grow inside the policy, made the loan bigger, and ate through all the cash value that was in there. And then what happened? He had to eventually cancel the policy because he couldn't afford the policy, and he got a tax bill. Like, that's the thing no one talks about, is the fact that you're still taking a loan.
It's funny. A lot of our clients who have these whole lives and have hundreds of thousands in it, it's always scary to start taking loans out because you got to pay the interest. And sometimes the dividends can pay it, but what if the company doesn't issue a good dividend, So
that's another thing too, is what is the dividend based on? Is based on profitability of the company and them making money. And again, you could have situations where they don't, and that would shell your dividend. And then from there, I don't know, again, we saw this happen, right? I've seen this happen live with a person.
Let's see. They haven't really gone into the whole. They're about to get into the infinite banking thing, so let's hear it.
Banks use this product to.
No,
to
they
park
do
money.
not. You've
Yes,
been watching
they do.
too much TikTok. Banks do
I don't
not
think
use
so.
whole life. Not ever. Banks
I
nowhere,
would-
no
I would
bank
res-
sell.
I would respectfully disagree
No,
with
they
that.
don't.
They can't.
do not use whole
Who are
life
they buying
life
the insurance
insurance.
on?
What bank?
Well, we Google it and see what typically banks do with their money, but I believe
Typically, banks never put money. Let me tell you what banks do. They put it in bonds. They're required to. They wouldn't be allowed by federal regulations to
No,
put it in
come
whole
on.
life.
Well, who? Absolutely correct. Absolutely correct. Every single insurance company, every bank, they all have mandates on how they can invest their money. They do not buy whole life as an investment.
They couldn't. It has to be on someone's life. The bank's
that's
not a
another
person.
thing.
You can't.
Correct.
Hey, J.P. Morgan, I'm gonna buy whole life on you.
The only time banks buy life insurance on
You
people
think J.P.
who work
Morgan's
there-
insurable, or you think he
Oh,
smoked? too
I'm
much?
sure they. Do you think? I think they definitely own insurance on Jamie Dimon's life, and that's because he's an important part of the company.
That's
And
completely
if he
different.
happens to die, it could seriously affect the company. That's why they buy life
Well-
insurance is as a hedge, because life insurance actually is not an investment. It is a risk management product. Plain and simple.
Well, let's see how Jim Googled it.
It's not a place to invest money because it's a horrible investment. The rate of return
4%.
sucks, and when you die, you lose your cash value.
I know, but you also you're making it sound like I'm losing money on the whole.
You
thing.
are. You're leaving money on the
You're
table.
you're making it sound like when not me, but my son, when he dies,
Yeah.
that he's only going to be able to get to his.
Well,
He's
my
going to have
grandkids are
$22
only
million
gonna-
less than he should have if you had put this in a good investment.
You had mentioned that the cash value dies and you only get the face value. That's
Correct.
not true.
That is true.
That's not.
I just covered that with you for the last 10 minutes. Paid up
Yeah, I know,
additions
but-
are the only way that cash value increases unless you're using a universal life program B
But that
where
isn't-
you pay
that isn't coming
extra to get the extra insurance, which is another form of paid up additions.
Absolutely correct. 100%. That is how that works.
So this is a good testament. Like, I want to know the video or the guy that sold Jim this infinite banking
Oh my
concept
God.
because
Can you reach out to us, guy
Yeah.
that sold Jim? Please reach out to us because I want to rip you.
not even. I mean, that's,
Oh, no,
I'm
I
just
wanna
curious
review.
what the sales pitch was because obviously he did a
You know,
good job.
let me tell you what the fucking sales pitch is every time. It makes me insane. It's they use words like bank, and they use words like infinite, and they use things that make people feel like empowered. They think-
Rockefeller.
yeah, Rockefeller method and all this stuff. It is such a bunch of bullshit. Anytime you hear something that you could do the same thing that the Rockefellers have done with their money, first off, you fucking can't, and you never will be able to. It is a different world. It is a different type of
Yeah,
planning.
it's different.
It is a totally different. That gets under my skin so much because that's what gives our industry a bad name. And whoever sold Jim that policy is an
Jim's kind of realizing he might have made a mistake here, and
Yeah.
he's getting flustered. I feel a little bad for him, but let's see.
It
what
hasn't
happens.
coming out of my pocket though. I put
It
70,000.
is coming out of your pocket.
It's coming out of the policy's pocket.
I know. The policy, you put the money in, dude. And then it paid you a dividend, and you chose to buy more of this crap with the dividend, and you're calling
Exactly.
that I kept my cash value. No, you didn't. You bought more insurance.
Well, I know that I put in 70,000, and at a certain age, it's going to be at age when he's 15 years old. That's going to be paid up.
Yeah, Jim,
And-
you understand
and-
what paid up is? You understand if you're alive, that there's a probability of your death. And so 100% of the time that a life insurance program is paid up, it means that you prepaid it. That's all it means. Because as long as there's a probability of death, there's a cost. So the insurance company has always got a cost as long as you're alive. So there is no such thing as a paid up. That's an industry term that gets suckers like you.
Oh,
That's what it is. No, paid up means prepaid. You paid all of the premiums
let him
in
rock,
13 years for his whole freaking life in advance. That's why it's paid up. Hey, man, I think you ought to keep it. It's perfect for you. But thanks for the call.
oh boy. Unfortunately, we've seen it a lot where these whole life policies are sold as an investment, or you hear about the infinite banking concept or this concept. And unfortunately, it's being sold to you. I'm not saying whole life's bad. I actually own whole life. There's reasons to own it. I don't own it as an investment. I don't think anyone should own it as an investment. Unfortunately, our industry, because we're lumped in with all these other clowns, it makes all of us look bad. That's why we like to break this stuff down for you guys.
Listen, there's a point at which life insurance, yes, you can use it in these very, very creative ways, and you can definitely make it work for you. This is not one of them. So there's going to be a follow-up to this video where we're going to actually go through the numbers. So Dave's right, 100% right. I cannot
Dave
deny
got me
it.
fired up.
He got me fired up. I actually started cursing. I got angry about this because the way that was sold to that man, that's snake oil. Listen, whole life's not a bad product. The death benefit of it is really great. Think about something logically too. If you really wanted to have a death benefit and you wanted to give somebody money, right, and you wanted to have that insurance, you're like, hey, I'm going to buy that. I want to make sure it pays out at some point, right, when I die. And if I buy it really young, it's going to be super cheap later on down the line. I agree with that. And that makes a lot of sense to me. But to buy it as an investment is absolutely silly.
All right, we'll see you guys in the next one.
See you on the next one.